Today, to fix or not to fix, that is the question. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and prop news with a distinctively Australian flavour. And I'm joined again by Steve from Canstar. Hi, Steve.
G'day, Martin.
Thanks very much for your time. Now, one of the interesting questions that I'm getting a lot at the moment with the recent changes in rates is, should people go for fixed rates or should they go for variable rates? And I guess it's partly a question of, are rates going to go further down, or are we at the bottom of the curve, as it were, and they're going to go, and should you lock in those low rates? What do you think?
Yeah, I get asked this a heck of a lot, and I normally give a real fudgy answer, but I always preface it and say, look, here's the deal. Now, the deal is that rates are going to go down. They're going down right now. They probably will keep going down because there's a 0.10 term funding facility that the Reserve Bank's providing. The 3-year bond rate is being held at 0.10% now. So this is a super low borrowing environment. How much further will they go down and what will the timing be? That's the tricky bit. My view is that, yes, they will go down. My other view, though, says, well, look, is that why you fix? And it's not really. We're not currency speculators. That's not what we do. We're borrowers who are out there earning a living and repaying loans. And my view on fixing is that you choose a time that has a reasonable price. You don't be driven by fear. And when rates hit 10%, go and fix. But when rates are on their way down, it's not a bad time to think about it. And you choose a time when you say, with rates at that level, even if they go a little bit further down, I can sleep at night. I know I can make this repayment. And if I can make the repayment comfortably, unless the wheels fall off, I'll be fine and I'll sleep well. And if rates might end up 0.5% lower, well, I can still sleep okay. So I think people can lose sight of that and think about speculation on interest rates when most times they get it wrong.
Well, I actually think of fixing more as an insurance against rates going the other way, right?
Yeah.
And, you know, the chances of rates rising from this point is actually quite low. I mean, the Reserve Bank's come out and said it's going to be really, really low for at least 3 years, and that probably means 5 years, right? So the chances of rates rising very far at this stage are relatively low. But what fixed does do, it gives you certainty. Right, and that certainly means that you are protected if rates would arise, but you also then take away the option of sliding further if rates would have moved down a little bit more. That's the other side of the coin, isn't it?
Yeah, it is, and that is a worry to a point. The bit that worries me most about fixing is actually at the other end of this. Yep. If you get to the end of your 3 years or your 4 years or whatever you've chosen, and you find that the market did actually move back up a little bit faster than you expected, and that your refinance position now is 4%, not 3%. That's the time. That's what worries me most. That you be locked in at a point where you see the inflection, but you're 6 months away and can't do a lot about it. That's the bit that worries me most, because you could end up sort of 2% worse off for the following 3 years. None of us have a crystal ball is the issue, though. And I think one of the real issues that people should think about at the moment is that you don't have to rush a decision because variable rates are so low. They're sort of around the same level as fixed rates. So you don't have to rush, provided you get yourself into a well-priced variable loan or a well-priced fixed loan. That's really the issue, because there's still a massive margin between top and bottom. We're talking about a couple of percent. So you just get into one of the well-priced deals and you can't go too far wrong.
And the point there, of course, is the old apathy tax, right? So if people don't actually get on the front foot and start looking and switching, they will be paying more.
Yeah, that's right. And look, the difference between a variable rates, the minimum's 2.19. It's come down in the last couple of days. This is a day old I did this. The maximum is 5.84.
Yeah.
So that's a 3.7% difference. The average is 3.37. Now, you shouldn't be near the average. You should be, about 0.8% better than the average at the moment. So there's a lot of room to play. And if you're anywhere near the top end, you've got to do something about it. Whether you go into fixed or variable, you'll be better off if you're getting one of the better price loans, miles better off.
And that really is the point, right? It's about the rate rather than whether it's fixed or variable in the current environment.
Exactly.
Yeah. But the other point, of course, is with a fixed loan, there are potentially break costs if you did need to break it early. And that's something else that people quite often don't understand, right? So it's important to understand how that might move against you as well.
Yeah, it is. And people don't get how that works. This is not a penalty. There used to be these big penalty exit fees. They're banned now. And it's only a reasonably small fee you'll be charged for exit. This is the economic cost. Now, that needs a bit of explanation. Let's say you've fixed it, one of the great rates today, 2.09%, and then the rate falls to 1.5%. But you say, well, I've got to get out because of X, Y, Z. I've got to sell the property. I've got to do this. I've got to, who knows? Lots of reasons. You will be charged the economic cost, which is compensating the bank for the deposit they've raised. So they raised a deposit thinking we're getting 2.09%. If they let you repay, they've got to reinvest that money, but they only get 1.5%. So effectively, you're compensating the bank for that loss. And that is non-trivial. If you've got a fair way to go on your loan, and if you've got a couple of years to go on your loan, and the rate has fallen by 0.5%, you can be up for $10,000, $20,000, $30,000, depending on the size of the loan. It's a pretty big number that can actually inhibit your decision making. So that's the risk you run. So if you think you'll want to repay part early, you can still go 50-50. If you think you want to get out altogether, well, you probably shouldn't be fixing it all, just in case, because that's the real big impost that could hurt.
Absolutely. And the idea of splitting between fixed and variable and having some in each camp is something which looks to me from my surveys that it's beginning to take more shape at the moment.
Yeah, it gives people more flexibility. We always say to people, look, there are three things. You look at the fees, you look at the interest rate, and you look at the flexibility, because you want to be able to get ahead by making extra repayments. And the stats show that Australians do that. You want a loan with redraw or offset so that if something goes wrong, you can still dip back into that money to get it back. They're the things that really matter with a home loan. So if you go fixed, you can be inhibited with what you can do, how much extra you're allowed to repay. Can you clear it in full? Well, probably not. Will there be an economic cost if you have to? Well, yes, there will. So you lose some of the flexibility if you go fixed. Going 50-50 means that you retain the flexibility on half. And how many people are going to get so far ahead that they fully repaid a loan or even repaid half of it? So that's how you can do it. 50-50, treat this one as very flexible and this one as fixed.
Right, and a sort of a question which naturally follows, because some of the best loans, particularly some of the fixed rate loans, are offered by some of the small lenders whose brands you may not know. Now, the question is, should you worry about that if you are a borrower? Yeah,
look, those brands have been around now for quite a few years, and they aren't known, and people do naturally feel nervous. And in times of uncertainty, the flight to quality, and the quality just means a big brand with branches on every corner.
And you pay more?
Yeah, well, you do. Although their fixed rates are very, very competitive. I mean, CommBank's gone to 1.99 for 4 years. Well, wow. Yeah. But the fact is that I think you can. They're all regulated by ASIC. Yes, some aren't regulated by APRA, but there's a sort of we're watching you anyway from APRA. And the thing with lending that's different from deposits is that with lending, you've got the money, and you owe them. Whereas with deposits, they've got the money, and you've got to hope they don't go broke. So that's the difference. And traditionally, when a lender does get into trouble, they'll sell off a portfolio of mortgages. These smaller funders that you've never heard of, that aren't approved deposit institutions, they actually have securitization deals. So, it's out there in the markets with insurance companies and superannuation companies. So the risk isn't that huge. You do a bit of due diligence and understand it, but I don't think people should shy away from any of those just because they don't know the brand.
Yeah. So the cornerstone question really is the rate, be it fixed or whether it be variable, rather than the brand. Some of the banks will hate us for saying this, but actually the brand is less important perhaps than the price.
Yeah, it is. There's always a little bit of uncertainty when you sign a loan contract, because you're signing a contract over 30 years and you've given the lender the ability to reprice it. And they can kind of reprice it without too many parameters around the rules. So that's the uncertainty. But that's an uncertainty whether it's a big player or a small player.
Yes, and that is the point, of course, because they do have latitude to reprice down the track, and you always have the opportunity to move if that's the case, I guess.
Yeah, that's right. Now, that's one of the advantages with fixed, is that they don't have that latitude for the fixed period. So that's one of the advantages. Whereas with variable, look, if it comes at an inopportune time, the repricing, it can be awkward because you might have trouble refinancing. Now that's always possible, and you've lost control of your timing to a degree. But these are the risks because it's a 30-year commitment, and they have to be able to reprice. There's no question.
Yeah, absolutely. Well, it's very important, Steve, isn't it, that people take the time to think this through and don't just jump at the first thing that comes up. Look at the different options that are there and make some careful choices.
Look, they need to do a lot of homework. They're non-trivial decisions. It's a great time in that it's harder to go wrong right now than when rates were 10% prior to the GFC, where you can make awful mistakes. But right now, it's a great time to be making these decisions, but don't take them lightly. Do a bit of research. Read all the educational articles. Our website's got dozens of them, so that you understand the ins and outs of this, and look at the choices. There are 4,500 loans on our database on our website. That's a lot of choice. So sort them by star rating, sort them by price after that, and build a shopping list.
Yeah, great advice, Steve. Well, thanks for your time once again, and we wish people luck with finding the best deals.
Thanks, Martin. It's always a pleasure.
Thanks. Take care. Bye.